Hi everyone, I'm Karunya Rao and I'm back with a new edition of Ideas for Profit. Today on our radar is HDFC Limited. HDFC saw a strong pickup in loan demand in the second half of FY21 due to low interest rates, softer property prices, concessional stamp duty rates in certain states and continued fiscal incentives on home loans. As a matter of fact, HDFC saw the highest business activity ever in its history in March 2021 in terms of loan approvals and disbursements. HDFC's outstanding loan book grew 11% in FY21. The growth in loan book was led by individual loan, which grew by 13% YOY. It constitutes 74% of the total loan book. HDFC's retail mortgage book is also growing much faster than the industry, and that indicates its huge size isn't a deterrent for the lender. The growth in individual loan book was aided by affordable housing segment. The lender is increasingly targeting the economically weaker section and lower income group segments in affordable housing, and traction continued in these segments. Corporate loan book was up 4% YOY. HDFC is amongst the handful of HFCs that is still active in the wholesale market, which has essentially turned into a lender's market where lenders command pricing, underwriting terms and covenants. This should translate into superior profitability for the company. While the second wave of the pandemic may pose challenge both in terms of loan growth as well as asset quality, we remain optimistic on the company as well as the stock. Despite the entry of new players in the mortgage financing space over the last many years and greater focus by banks on this segment, HDFC has maintained its market share. It has delivered consistent and superior profitability for more than 3 decades now. Its earnings profile is marked by healthy interest spreads, low expense levels, and good returns on net worth to equity. As a matter of fact, HDFC has been a key beneficiary of the structural consolidation underway in the housing and real estate financing business and will emerge even more powerful in the aftermath of the pandemic. Many NBFCs and HFCs have been rendered weak and are seeing strong growth, and some are even vacating the wholesale lending business. And this will help HDFC further accelerate market share gains. While loan growth has remained healthy, HDFC has seen a steady rise in bad loans, especially in the wholesale book. The street's concern about higher slippages in HDFC's fairly large non-individual lending book, which constitutes around 26% of the total book, is valid. However, there is comfort from HDFC's conservative and higher provisioning and strong capital position, which got further enhanced with the capital raise of 10,000 crores in FY21. Most importantly, while the performance of the core mortgage business is encouraging, HDFC stands to gain from equally strong performance of its subsidiaries and associate companies. As on end of March, the unaccounted gains on listed investments in subsidiary and associate companies stood at 2.61 lakh crore, plus there is value in unlisted subsidiaries like HDFC Ergo. Even a small stake sale in any of these investments could significantly boost provisioning if required. HDFC's NIMs came in at 3.5% in FY21, increase of 10 basis points YOY, as the lender has gradually unwound its high liquidity levels maintained since March last year. It reported a net profit of 12,000 crores in FY21, a decline of 32%. However, the net profit is not directly comparable with the previous year because of one-time transaction. Last year, the company recorded a fair value gain of 9,020 crores due to merger of its subsidiary Group Finance with Bandhan Bank. However, adjusting for pre-exceptional items, pre-tax profit would have been 13,823 crores, representing a growth of 19%. Overall, GNPA stood at 1.98% of the total loan book as at the end of March. There has been a steady deterioration in asset quality on the wholesale book, with GNPA at 4.77% at FY21 end. With the slowdown in the real estate sector and incipient stress for developers, HDFC's sizable exposure to the builder and corporate segments will remain a key monitorable. It also restructured loans amounting to 4,400 odd crores, equivalent to 0.8% of loan book under RBI's resolution framework for COVID-related stress. Provision coverage ratio improved to 52% for stage 3 assets versus 48% at the end of previous fiscal. The management's policy of creating 30% provisions from one-off gains has resulted in total provisions of 2.6% of exposure at default, which is in excess of the regulatory requirement. As per regulatory norms, HDFC is required to carry a provision of 5,491 crores, against which it held provisions of 13,025 crores at the end of March 21. HDFC's core lending business is getting valued at 1.9 times of FY23 estimated book value, which is reasonable. Though the second wave of the pandemic will definitely add volatility to the quarterly earnings in FY22, the performance of HDFC is likely to remain strong. Most of its subsidiaries and associate companies, HDFC Bank, HDFC Life, HDFC AMC, they all have an equally blazing track record. While the valuation re-rating of the core mortgage business is contingent on real estate sector's performance, the future stock upside will be driven by the subsidiaries. Investors should buy the stock for long-term gains.